mutual funds today, it's a very evolved animal. 30 years ago, it was a very, very different animal altogether. Now, if you look back, one of the earliest things people remember today, when you go back in terms of capital markets, is the 1992 Harshad Mehta scam.
I happened to be in thick of it at that point of time. I worked for the firm which was at the forefront of equity revolution.
The name is Shah, Bharat Shah on MF Chronicles. When the markets are shaken, his conversations stir. From chaos to clarity, he built the way India thinks about investing.
In a way, I suffered a lot during that period. In all that depressing environment, I felt that the future is going to be very bright and significant.
But you were into investments, into the capital market, into the secondary markets. What was the mood at that point of time? What were people thinking?
Mid-90s was a period of, if I had to describe it, death of capital. There were scandalous number of very poor quality companies and very poor quality businesses which could raise money. And there were a mushrooming number of IPOs which came to the market. There, people did not lose 5-10% of what they put. The money simply evaporated. It just went away. It was sucked away into vacuum. What index touch in 92, it finally reclaimed in August 2003 after good 11 years.
Good evening, Bharat, and thank you for gracing our show. One of the reasons why we are doing this is basically to chronicle the history of mutual funds. When you look at mutual funds today, it's a very evolved animal. You know, there's a lot of technology, a lot of people, a lot of stakeholders in the business now. But in the good old days, and I'm using the word good old days deliberately, and I'm talking about 30 years ago. 30 years ago, it was a very, very different animal altogether. And I've had the pleasure of working with you. And I've seen people like you, stalwarts like you, actually work through it. At times without even realizing that you were shaping an industry, okay, which was happening. So the attempt of this show is basically to chronicle the entire history, right? Now, if you look back, one of the earliest things people remember today, when you go back in terms of capital markets, is the 1992 Harshad Mehta scam, as they call it. And that has been popularized because of a television serial, correct? But actually, most people don't even realize that there was another revolution happening at that. I don't know whether you remember, VSNL, Videsh Sanchar Nigam Limited, had just launched the dial-up connectivity at that point of time.
Fountain.
At Fountain, right? So, and I don't know whether the students here would realize that it took 3 hours to download a 5 MB file. Okay, so those were the days, and that was another revolution brewing. You know, it was what we know today as the digital stroke knowledge revolution. We've all benefited from 1991, Manmohan Singh's liberalization reforms. But 1992 onwards, it became a very different thing from the capital market point of view. I think SEBI was born around that time. You had dial-up connectivity happening from VSNL. And of course, you had all of these scams which were also coming through. I want you to just take us through that summer of 1992 when you were managing money, sitting inside your room. At one point of time, you were handling the largest group of analysts in one of your firms. What was the mood like, you know, when this whole thing broke out in 1992? And just take us through 1992, 1993, you know, this whole, what happened during the Bombay riots, and even before that in terms of the Harshad Mehta scam. What was the mood like in the investment fraternity? What were you seeing? What were you doing? How were you reacting?
I happened to be in thick of it at that point of time. I worked for the firm which was at the forefront of equity revolution, which is Gromor Research in Asset Management. And that was, while people obviously know Harshad Bhai and Ashwin Bhai, Harshad Mehta and Ashwin Mehta is household kind of names. But Gromor as a firm is something not many people are familiar with it. But I can tell you that whatever may be popular descriptions in the aftermath of the implosion of the markets which occurred in that period, and Markets went into tailspin. There was a lot of impact in the investment sentiment around at that point of time. All I can say, at least from my limited or understanding perspective of being in the thick of that storm which was brewing at that point of time, it was a phenomenally visionary effort at equity investing in an organized way, in a methodical way. What I fondly remember is that deep commitment to the creating fundamental foundational stone for equity investing, rather than the popular image, whether in the serial or otherwise, people may describe. I'm not taking anything away from some of the adverse situation the firm found itself in, and some of the mistakes that occurred at that point of time, without any question. But the firm itself was seriously into the task of crafting the journey of equity investing and wealth creation. I would say the first major significant effort in that direction to come out of this country. Please also remember, in 91, the country was on the brink of disaster.
Correct.
Where it would have defaulted on its international obligation.
Correct.
And we just saved ourselves in the nick of the time. Correct. That provided a backdrop for finally ushering in much delayed, much needed beginning of economic reforms. And there was the breath of fresh air, a spring in the tide, I would say, in terms of people looking forward to as to what could have, what is going, what is lying ahead, and the journey to be carved out. Prior to that, if you see the journey of the country and her markets and her investing prowess of the country, it was only characterized by, prior to that, by very rudimentary, very primitive kind of environment of the markets, trading practices, investing culture was not even formed, or was not in any serious way, even in reckoning. And I remember even investment books at that point of time to find was so tough, because there were no books in India on the investment. So there was no literature. And all the international books were so difficult and expensive for anybody to afford and even think of getting them. But I practically worked during that period 7 days a week, Monday to Sunday. Even Sunday I used to be in office. Sunday used to be a little latitude where I leave office at maybe 4:30, 5 o'clock in the evening. Other days, practically office was like a be-all and of everything there. It was a period of such tremendous learning. I mean, so much idea generation, so much of energy, so much of actually intellectual fertilization of the rudimentary financial journey of the markets at that point of time. And I have nothing, even though personally, in a way, I suffered a lot during that period. I was without work after as the firm imploded and things went into a tailspin. I was without work. Markets were torn apart, and there was virtually no opportunity to find any other work. And here I am, uh, guy from a low middle class with no money to fend for except month to month, living with a paycheck. It was tough. And it lasted a whole of a year where I was without, I didn't know what to look forward to. And I didn't even have it was such a foggy environment that what is going to come out eventually itself was not only unknown, but unpredictable in complete sense. I think there was, in all that depressing environment, I felt that the future is going to be very bright and significant. And that hope just allowed all the misery to be forgotten.
सर रुकी उस समय मैं था 92 में I passed out of this institute straight into the job world and then all of this chaos happening. But I guess one of the advantages was I was at the other end of the food chain. So because you're so close to the mountain, you don't know how big it is. And to take that analogy, because you're so close to what you're doing, you're at the lower end of the food chain, you really don't know what the crisis is and you would rather look at the opportunity. I think 1-2 साल पहले Dhirubhai Ambani had just gone public with the Reliance Petrochemicals thing at Patalganga, right? And I think that was fresh in everybody's mind. So I guess you're right. You've had more of a perspective looking through, and I think at the position you were in, it is harder to be positive in a depressing scenario than at my end, wherein I knew so little. But one of the things I think...
but just on that, I mean, again, since you took the name of Dhirubhai, and I was fortunate enough to be meeting with him not once, twice in that period. Wow. I was just die sitting like a fly in the wall when Harshad Mehta and Dhirubhai Ambani, there were meetings and where I was privileged enough to be allowed to join that meeting, and I just sat. But that's what I'm saying. Why one would be optimistic? Because when you meet people like Dhirubhai Ambani, you realize the power of imagination and never say die kind of a mindset. The sheer entrepreneurial zeal of changing the destiny of the country and proving the point as to what can be done and what can be achieved. It's very easy to forget the seeds which were laid down to build ethos of entrepreneurial power in that period. It is only with the power of such entrepreneurship that countries get built. They get prosperous, they get rich, and the people get uplifted, and whole societies get transformed. Absolutely. So many times we unfortunately view many of these situations with so many less relevant and immediate points or telltale signs, forgetting the deep and very powerful contribution that emanates from people like this.
One of the things I think which I've realized is that once there is a regulation or a structure which comes in, I think the relevant industry starts doing much better. And I think that is what really happened when CCI got abolished and SEBI came in 1992. I think that was a sea change of how things were done. And there was more disclosure, more emphasis on governance. Around that time, you were also into investing. So when you're looking at the world outside, and SEBI had just come in. I was in merchant banking at that time, so I can tell you that it changed my world when I was looking at it. But you were into investments, into the capital market, into the secondary markets. What was the mood at that point of time? What was happening? What were people thinking? Now that SEBI has come, what has changed? The free pricing norms, all of those things. Just want to read your mind on that.
You're talking about mid-90s.
Mid-90s, sir. Mid-90s. When SEBI had just been announced here.
In a way, mid-90s was a period of, if I had to describe it, death of capital.
Death of capital.
Yeah. I'm not referring to the implosion of the market that occurred in 92, 93, and in the aftermath of that, there was a sharp fall in the market. I'm not even remotely referring to that. I think around that period, there were scandalous number of very poor quality companies and very poor quality businesses which could raise money.
Correct.
Mushrooming number of IPOs which came to the market with virtually no restraint or no control over any one of them, with God knows what kind of background check on these firms had.
Yeah.
And therefore, it was not a case of bad businesses or bad entrepreneurship which resulted in lot of capital raise which evaporated. Fundamentally, these were most crooked and unethical people who came to the market and found it very convenient to get capital easily. In that period, for businesses to find organized source of capital like markets was just beginning to occur in markets in India. If you recollect the period of 70s and 80s, the businesses that gave reward to the people were only typically multinational types.
Correct. You had the Birla MNC fund, right?
We had a Birla MNC fund, as you recollect correctly, in 90s we had set up. But in 70s and 80s, that MRTP and FERA Act which were there, and these were firms which were extended offshoot of their global parents, be it Colgate or be it Hindustan Lever, as it was called that time, and many other firms of this kind, Pons and Brookbond and Glaxo and Main Baker and whatnot, Kestrel and large number of firms. These were the only firms which really made money for investors because these were serious and settled businesses. They generally were consumer facing or akin to that, even pharmaceutical firms and those, or good engineering firms, or some strong automobile related firms like Myco Bosch. Barring these firms, very few firms really made money for investors, and remarkable exception to that rule was the Reliance, which journey began in 70s, and then it built itself based on that cult of public participation, and that cult of public participation wouldn't have been possible unless people made money, and therefore, barring solitary exceptions like Reliance and maybe one or two more, a few more, I would say. Most of the Indian firms did not make any meaningful money for the investors. Only they suffer. The firms made money, but not the investors. So multinationals and some of these firms were the only connect of the people to the market, and which is why that popular belief was that markets are not a place for it's a scum's game, and it's not something that any self-respecting individual would like to be associated with, and that it was regarded more like gambler's den rather than a serious pursuit of what is actually a very intense exercise of investing.
Mm.
So the firms in 90s which imploded, I'm not talking of the drop in the market that occurred in the wake of what happened in 92 and markets collapsed and came down. But in 95 onwards, so many bad people, so many bad businesses, so many crooked entities with so much relative ease could raise money and simply disappear. Many of the firms didn't even exist. Actually, if you go and check at the address, the firms were not around. I mean, the people behind them simply disappeared in thin air without any of them brought to justice or put behind bars. Therefore, I would say 95 or thereabouts was a death of capital. It turned away a serious class of people from investing into, they got repelled away from the market. I'll give you a data point. In mid-80s, around that time, roughly double digit, about 13, 14, 15% of the household wealth was in equity markets that time.
Really?
Yes, in 80s.
Oh.
And then that number only dwindled and dwindled, where before these inspired run in last few years has occurred in Indian markets where they really have come into their own. That number was standing at 4.5%, 5%. So it was not as if it was always that way. In 80s, the amount of wealth committed to the equity investing was still material. May not by a global standard, but it was not a puny number like 4-5%.
Absolutely.
It still was 13, 14, 15%. 90s did that IPO, bad businesses sucked away capital, destroyed appetite, and probably a generation of people got repelled away from the markets. I think that was the unfortunate damage. So much so, despite the huge ice boom, information, technology, communication, entertainment, that boom started in around 98 or thereabouts and went on till 2001, phenomenal boom that occurred. A lot of it, some of it meritorious, a large part of it was illusory. Yet, despite that boom, what index touched in 92, it finally reclaimed in August 2003, after good 11 years.
That's an index of 4,000?
Somewhere around that. Somewhere around that. I think it was even lesser than that.
Lesser than that.
It was even lesser than that. It took away some decade and more before markets simply came back to where they were. That is the kind of damage that poor quality capitalization, IPO scheme, and total crooked people who got a currency during that period of 95, 96, 97, 98. I think that 3-4 year period from 94 to 97, 98 was really death of capital, I would say.
I would completely agree with you. I was actually in the thick of things on the other side, the merchant banking side.
Yes.
So, आपने CRB का नाम लिया. Incidentally, I don't know whether people are aware, CRB is the only mutual fund to have been shut down. Correct. There has been no other mutual fund which has ever been shut down.
And rightly so.
And rightly so.
And should have been done right from the word go, actually.
In fact, the 94 to 96 period, I think has been very significant in a lot of ways. आप जो बता रहे हैं, death of capital is one of them. And honest to God, I didn't know about the fact that 13 to 14% of money used to be parked in capital markets. And I guess one of the vehicles which pulled in a lot of money was Mastergain. UTI Mastergain pulled in a lot of money. And then there was Morgan Stanley, which happened around 94. मैं क्यों Mastergain की बात कर रहा हूँ? Because this struck me. आपने जो 13 or 14% बोला है, कहाँ जाता था पैसा? A lot of money used to get picked up by UTI. And then, of course, the whole master gain episode happened. I think the whole share certificate, duplicate share certificates, and all of that happened, which I think was something which was, I don't want to use the word sign of the times, but if you don't have digitization at that point of time, this is going to happen. So 1994 was CRB at one end. Okay. आप शायद बिरला में थे उस समय. Okay. आपने शायद स्कीम भी लॉन्च कर दी थी 94 to 96 के बीच में. I had also joined Birla around that time. And then उस समय आपके पास Morgan Stanley भी था, Master Gain भी था. Very like this, the Chinese saying was very interesting times. Correct? So जब आपने scheme launch किया, I think Birla was the first one, or I think Kothari was the first one. Birla was the second one to Kothari pioneer.
Almost immediately. Birla Mutual Fund.
Apart from Morgan Stanley, everybody had open-ended schemes.
That's right.
Correct?
That's
so
right.
How difficult was it when you're talking from a Master Gain stroke Morgan Stanley vintage as an investor? आप उसके पास जाते हो बिरला म्यूचुअल फंड में या अलायंस में या कोठारी पायने में बोलने के लिए कि मैं ओपन एंड म्यूचुअल फंड बेच रहा हूँ. You would have interacted with several investors and you would have talked to your teams also. Just take us through some of those insights.
No, it was a tremendously exciting project. I mean, in a way, it was Birla Mutual Fund was a startup.
Yeah.
It was the first startup in the financial market. Unit 64 or the UTI, Master Gain, what you talked about, but Unit 64 existed since 64. And even I think a little earlier than that. But truly, Birla Mutual Fund and Kothari, and a little later, I think ICICI Prudential came.
So all the guys
came in that time frame. But Birla Mutual Fund in investing, in organized retail investing and channelizing
money,
systematically savings and productive capital of the people in a trustworthy format, and to navigate through an environment where a Morgan Stanley fund can quote at a premium to NAV, or Master Gain can quote at a premium, or when side by side was brewing spectacle of totally disastrous IPO raising money and all getting evaporated into thin air. So in a way, this was an experiment at rebuilding the equity culture of the country. The society, in some sense, mutual fund from that time became a push product rather than a pull product. It should have been a pull product because that is how probably retail, which otherwise was doing it on DIY format, do-it-yourself format, and generally suffering and losing money. This was the first serious attempt at giving expression to even small amounts of money, either on an ad hoc basis or later on a systematic time interval based, what is now called SIP. These were hugely important attempts and reforms to bring back the equity culture that this country had, of course, on a selectively limited number of companies in 70s and 80s, but which lied in tatters due to the events that I described. And therefore, that effort to build that trust was hugely bizarre. But we had an advantage. I mean, on one hand, we had a very credible name like Birla, which was backing such a startup. And on the other end, even though capital wouldn't have been known in this country, but capital was one of the most respected institution of its kind in the world from America. Being, if I recollect correctly, it was set up in 1917. So therefore, we had truly two very highly credible names backing that venture. And therefore, we had a lot of good legs to stand on and to talk to the people. But it was an exercise in education. Also, we must remember, this was also, apart from equity, this was the first time a fixed income kind of an exposure other than a bank deposit in a more convenient format, in a more package format, and with a greater liquidity than what deposits typically offered, and yet retain the chance to earn returns better than the deposits would have offered. Somewhere along the line, tax benefits also got mingled, and therefore, seriously, it was in the non-equity arena. This was a remarkable attempt to create productization of the regular financial savings, not only for the retail, but also for the companies where their treasury, their short period surpluses could find an expression and earn some return. Also, it allowed price for money to become more efficient rather than left into the hands of only banks to discover the true price for money. And therefore, this allowed greater sophistication of the entire non-equity financial system itself to evolve. This was the very powerful, so to say, foundation stone was laid down. And today now, banks routinely complain that the deposits are being taken away by mutual funds, and really speaking, mutual funds should be, so to say, kind of controlled or whatever. But to think of it, that just 30 years back, and since then, this has now become a serious effort at financialization of the system.
It just took me back memory lane. I must share with you that apart from talking about mutual funds as Hamara Tumhara fund, because that was the knowledge which you had to do, we also used to say कि इसमें equity नहीं है. Okay, at one point of time, because doors were being slammed in our faces. In fact, on our cards, if you recollect, it was written as Birla Capital International AMC Limited.
Yes.
तो मुझे अभी भी याद है कि मैं एक ऑफिस में गया था, तो रिसेप्शनिस्ट ने मेरा कार्ड देख के बोला, अरे बिरला से कोई एनुअल मेंटेनेंस कॉन्ट्रैक्ट वाला बंदा. And honestly, because those were being slammed in our faces, Morgan Stanley, Mutual, ये Master Gain. But I think one of the things which really worked for us, thanks to people like you and NK who trained us, is indexation. आज जो बात कर रहे हैं, and that became a very powerful way to attract institutional money. So suddenly, from 5,000, 10,000 rupee checks, which were big, we started getting indexation money from treasuries.
Okay.
One very famous cricketer at that point of time, I don't want to name him, put in money in a liquid fund. And by the way, I should tell everybody that not only did we have Birla Income Plus, was Birla the first income fund of its kind?
Yes, and we the first Birla, liquid fund, Birla Cash Plus.
I still remember the date, 7th of July 1997, because that is when Rajesh Bhojani's daughter was born. The date yaad hai uska. And then, of course, the whole industry took up to it. And I think it was 2002 or 2003 that there was a Birla Bond Index Fund also which was launched. So, most people usually talk about equity and your contribution to equity, but in terms of the fixed income markets, the way you've seen it grow and the way people like us have been groomed to take it forward, I would dare say that this entire distribution network which was being formed at that point of time pivoted to Birla Income Plus or an income fund. And then, of course, there was a plethora of income funds which came in, which actually led to the first wave of growth before it happened. Which actually brings me to the next point is 97, 98. I think the big thing was the Asian crisis which happened at that time. I was having this discussion with one of our colleagues, and most people today talk about the Gulf War as a war which brought war into our living rooms through color television and all of that. But the Asian crisis was the one which actually brought a financial crisis into our living room, because I think internet had just started coming up. There was convergence of information happening, panic happening. And one of the things which was really hurting countries like us was this factor of FI exodus. And there was FI exodus. You have lived through that FI exodus. Today हम लोग छाती खोल के बोलते हैं कि कोई फर्क नहीं पड़ता, FI जाएगा, DI खरीदेगा. लेकिन उस समय FI बेचेगा with that sort of liquidity in the markets. As a fraternity, you and your colleagues in other funds, you would have all been affected by one FI moving or two FIs moving, right? So what was the thought? The first FI exodus probably would have happened in 97, 98.
Correct.
तो आप लोग का कैसा रिएक्शन था, आप लोग ने कैसे उसको हैंडल किया, and what were your learnings from all of that?
It was deeply chaotic. Because here was a country which itself was in a difficult shape. We discuss about the backdrop of the 91, where India came close to default, and aftermath of that, the reforms and all of that. But it is not as if the easy work of the reforms was done in that particular period. But I think the system needed repair and healing before serious investment can come to take the economy forward. Investment not only into the markets, but into the businesses. And because the country was starved of capital. Therefore, the limited capital that came from abroad and fixed income capital did not come at that point of time. The first lot of money came into the equity money. Fixed income money came much, much later.
No, I'm talking about equity money.
Yes.
Yeah.
At that point of time, when you think about it, our destiny was simply not in our control. And therefore, popular saying was that if America sneezes,
the world
and India will develop all kinds of terminal diseases.
Yes.
I mean, even at that point of time, it used to annoy me endlessly to hear that kind of a description. That means you have really you don't have an identity of your own. You don't have your fate. Your fate is lying in the hands of some guy sitting in London or New York or etc. And I used to get deeply upset about how, in terms of substantiveness, we mattered so little, and we sounded so much like a speck of dust, a peccadillo in terms of what we meant to the rest of the world. Foreign money first time came into equity in India in 93, and then slowly it began to raise the head, and some of the serious investors like Capital, even till date remains one of the largest investors in Indian markets. But a serious long-term investor like Capital came around 94, 95 to build it. But most of the foreigners, because the foreign money is of all kinds, there are India dedicated, there are long money, there is part of some kind of a concoction, sometimes called BRICS or emerging market or Asia Pac or whatever, and very little India-specific belief or direct money was there. And therefore, that money spoke far bigger and far louder than it deserved to. For a rupee or dollar of that money, in terms of the impact, it was like $10 into the system. And therefore, your destiny was at ransom in many cases. Why even then? I would say even if you take, say, 5, 6, 7 years back, till then, foreigners, foreign money had in disproportionately large and often destructive impact on the markets in India, which was many times not called for. Recollect in 2008, global financial crisis.
Correct.
Really speaking, India had nothing to do with it and had no really reason to suffer from it.
Correct.
But it did. I mean, we witnessed one of the worst kind of meltdowns in the market, where Sensex lost 68% in less than 1 year. Nifty lost some 69%. Mid-cap index lost some 72%. And small-cap index lost 83%. In a period of just 1 year.
Pretty much your wealth wiped out.
All because some Kelaus, greedy and corrupt money in America fell apart, and we suffered in consequence of that. Therefore, really speaking, you didn't have meaningful control over your destiny. Prices in the markets are an outcome of merits, but over a period of time. Prices in the market at a point of time are a function of the power of the money which is in or out, and the so to say raucousness of the noise that money makes at a point of time, or of the emotions associated with it. And therefore the game was cast against you. Here you were in a country where economy was just trying to find feet. The culture of entrepreneurship was beginning to acquire some meaningful shape, but prior to that we witnessed those very bad IPOs which damaged the sentiments. And the markets were rookie, investor confidence was low, and therefore some stray foreign money or foreigner deciding to wake up from the wrong side of the bed could affect the fate of the money that you were managing, and that over which you had no control in the short run. And here you are running a structure which is open-ended, and therefore it requires only for them.
So how did you manage? I mean, redemptions coming in from retail. What sort of learnings were there in risk management, liquidity management? If you can give us some insight.
Which is where it all began. You started very clearly realizing the risk underlying that activity. I mean, in the fixed income, the risk underlying a quest for higher return and sacrificing quality of the paper or liquidity of the paper. We know what happened 6, 7, 8 years back, and how funds were fixed income funds came close to collapse.
Correct.
And couldn't honor the commitment, and resulted in real disaster moment. And that was not long time back, just 6, 7, 8 years back. Therefore, even though these foreigners had nothing to do with the funds that we were managing, we had to be mindful of what they could do. And many of that foreigners really had little idea about India or little idea about Indian opportunity. Most of them came on a quirk or on a whim, I would say, barring a few serious committed ones. Fortunately, some of them have still been there till now. You couldn't have said the same thing about others. Therefore, there was always that lurking thing, and therefore it could once again give a bad name to market. And every external event can get amplified and extrapolated, like Asian crisis, which again had nothing to do really with India, because India was still very inward economy. It was protected from outside, while the cancer of Asian crisis was in the externalization of Asian champions, like your Korea and others, where they witness, or Japan, and what they witness terrible problems in their own situation. So, risk control, trying to make your investments more granular, because then you ensure that those investors really remain with you long term. Plus, anyone doing something doesn't impact your own structure too much. On the other hand, you have to build an education effort of a sustained nature, and which is not merely communication or keeping your client informed, but a genuine education effort that, look, these are the conditions, these are the situations, and therefore we have to find a way out of that as an economy, as a nation, and as markets. And therefore, with patience, we can build a value creation journey. And not only for us as individuals or a firm, but for the vehicle and for the mutual fund industry itself. So many of these went parallel. Internal practices became more evolved, where greater recognition of internal failures which could come by, which could be compliance failures, and compliance not in a very technical way, in a real sense. Where you genuinely uphold that trust of the people. You can make mistakes, but they have to believe that you will be, whatever you are doing is for their good and for that commitment. That itself required a lot of effort to be built. So internal systems, risk matrix, supervision by the supervisory structures, whether from the board or from the trustee firm, creating communication bridges and a genuine reaching out. And just because somebody has put a few thousand rupees only, you can't really say that I don't have time or the availability to talk to you. So even at that point of time, where mutual fund fundamentally is a faceless and kind of a remote organization, because millions of individuals can't be directly be connected with the way the private money is expected to do. Yet you had to build that element of trust, that you care for them, that you are a protector and trustee of their interests, and that we are willing to account for our actions to you in format or through the mechanisms whereby you can develop that faith. So I think the work had to happen on several fronts, because then only you can hope to retain money and not fall to the prey of every rise and fall of the market. You become on tenterhooks only by retailizing that money, by making it granular, by making it disciplined, by making it systematic over a period of time, where it became a habit rather than a quirk at a point of time that you cut a check and give, and not for them to get thrown off the centrifugal force when the markets are against you. I think that is tremendous. When I think about it, sometimes it sounds difficult that we survived and we grew through that.
Goosebumps while you're talking. You lived through that. In fact, आपको एक मजे की बात बताता हूँ. You talked about education, and yes, we were talking a lot to people कि income fund कैसा होता है, because I think 98 Jan 16, 1998, RBI raised the interest rates. I think it was in response to this crisis, and for the first time, liquid fund NAVs fell across the India.
Absolutely.
It was a Saturday.
Negative.
India Bangladesh का cricket match चालू था, and Rishikesh connected hit a 4. मुझे क्यों याद है क्योंकि उसके बाद life became hell for the next 15 days. So हमारे जो बॉस होते थे इनके, उन्होंने हमको फील्ड में पुश किया, पूरा स्क्रिप्ट दिया कि यही बात करने के, and we went out there. And I think there was an ad in the newspaper. I don't remember exactly what year it was, but था कि investment advice, call on these numbers, which was the Fort office number, not Fort, Nariman Point office number, Raja Center office numbers. Now, in a quirk of fate, जो numbers थे, हमको इनके ने बोला ये कॉल फॉरवर्ड करो घर के लिए, क्योंकि वीकेंड पे कॉल आ सकते हैं, क्योंकि फ्राइडे को ऐड डाला था. So I remember weekend after weekend we were taking calls and telling people calm down, there's nothing to worry about, you know, ये हो जाएगा. And what helped actually the industry was a T+5 redemption time frame. We were not obliged to give it in 2 days.
The next day.
Yeah, so we used to tell people, take it easy, your money will come and all that. But while you were talking, it was just giving me goosebumps. In fact, you've actually set the context. Now, you know, when I look at things from 91 onwards, and I've seen things come back, which partially actually starts to explain the euphoria around the dot-com boom.
Yeah, but just before that, amongst all these challenges, a hugely positive that I want to describe in the 90s was emergence of firms like Infosys and Wipro.
Correct.
I think that came in like a breath of fresh air.
Correct.
And it sounds scandalous today to believe that IPO of Infosys failed when it came, and it had to be supported by the investment bankers to make it run through. Today, when, if I'm not mistaken, it had come at a price of 95.
70 रुपए.
70 रुपए.
क्योंकि मेरे को ऑफर आया था, विकास डाल दे 80 रुपए, 800 रुपए डाल दे. मैं बोला क्या करता है कंपनी? तो सॉफ्टवेयर. मतलब सॉफ्टवेयर में कौन पैसा डालेगा? हार्डवेयर है तो बता. My biggest learning.
So
70 rupees.
But why that was important? Apart from very courageous and gifted entrepreneurs like at that point of time Dhirubhai Ambani, but professional entrepreneurs like Infosys or Wipro, Azim Premji, who entrepreneur in a huge way in his own right, at the same time a kind of a professional entrepreneur with the ethos of that professional structure around that. That came as a breath of a fresh air. Many of those people were different, their backgrounds were different, their language was different, their businesses were different, the models they were seeking to build were different. And many of them sounded almost like the middle class people from whom they raised money and built the businesses. They didn't look too very different from that. And yet brought about a culture of a certain kind of a governance that became defining one in many, many important aspects. I think Infosys came to define certain governance principles and ideas which would have taught a thing or two to the Wall Street and Western world without any question. The kind of value system and ethics that a firm like Wipro came to symbolize and represented, I would dare say, very, very hard even any the fountainhead of capitalization like America, too many firms can really claim for that title. So I think along with many challenges and adversities, but I think simultaneously with a creative destruction, while a lot of rotten things were getting destroyed, and rightly so, I think we were giving birth to some fantastic, fresh new opportunity.
No, in a way, I mean, this is beautifully articulated. In a way, I think if one has to use this thing, it was a software update for India, which actually was happening at that point of time. Bharat, you were one of the few people who was prescient enough to see the opportunity beyond the noise. Okay, you could see. I mean, I know because I used to interact with you quite a bit, from Y2K to .com, and which is now e-commerce. I think you probably were prescient enough to see what was happening at that point of time. Also, there were a lot of funds which were being launched at that time, the IT funds. So, two things I wanted to understand. One is your perspective, your vision, how you saw beyond the noise, because it was very easy to get carried away in the noise. I think I jokingly tell people today, Hindustan Lever had released a press release saying that they're going to launch a website. The next day, the stock was up 3%. People laugh at me even today, but if you remember what I'm talking about, right? There was frenzy which was happening.
You just need to hear name taking.
Absolutely, right? But you managed to see beyond all of that, which is why I think but that was one of my learnings. You managed to see all beyond that. And also, this frenzy of launching funds. This was, so my question is, okay, the frenzy of launching funds is one side, which I think was more market driven, but how did you assess the opportunity beyond the noise? What was that came about? Because there was so much of jubilation, there was so much of happiness. You talked about wealth creation, and coming in from 91, one can understand that this was probably the spark which lit the fire. But at times it was a little bit of smoke and no fire, yeah, which is what the valuations ultimately turned out to. What was your perspective? How did you break it down? How could you see 10 years ahead? That will be a great thing for us to know.
Well, I had my own share of mistakes. There were some mistakes I avoided, but some others I succumbed to, and I'll come to that a little later. But before that, I think what appealed to me at that point of time, that when you meet with people like Narayan Murthy, when you meet with people like Nandan Nilekani, when you meet with people like Azim Premji, you realize that for the first time, you are meeting with a bunch of people who are very different than the typical image in which entrepreneurship had come to be viewed or was regarded as. I also instinctively felt about one important thing, that the size of opportunity of this activity is tremendous. That technology, in a way, I'm a tech challenge individual. I don't have any, I don't have well-versed capability with exploiting technology and do a lot of stuff. But fundamentally, it looked very clear that technology will dramatically alter the first agrarian revolution 400 years back, then the first industrial revolution, and then the second industrial revolution, and then the information technology revolution in 1970s that was brewing. It became apparent that technology is not only here to stay, but it will make dramatic changes in the way businesses are conceived, the way business models remain viable or otherwise, how they can become more productive and efficient, and how it can both be an opportunity and a threat. To the lazy businesses, it can be a tremendous threat, and in the hands of agile opportunity seeking, it can be tremendous power. And one could very clearly see that India per se felicity with mathematics, basic engineering capability, information technology capability, and at a scale provides a phenomenal bridge between technology creator, firms like say Microsoft and what have you, and technology users, which is millions of enterprises. You need a gateway in between who can make the two sit together and provide a solution for their day-to-day problems. Microsoft can't solve the problems of each individual firm, Each individual cannot exploit Microsoft software efficiently and build a solution within. But Infosys can, and Wipro can, and TCS, which came much later as a listed entity, though as a firm, it was ahead of any of these. You needed that service. And the greater mark that technology will make, greater will be the need for this. And finally, I felt that these are businesses which were in a country where return on capital employed of the balance sheets were very poor. Balance sheets were typically debt laden. Return on equities were poor. Here are businesses which are fantastically cash flow generating, earning margins at that point of time closer to 40 odd percent. Today, these margins have come down to 23, 24 for the best names. But at that time, 40% plus margins were on businesses making 70, 80% ROC, and on their small base growing at a rate of 50, 60, 70% on a top line. I mean, this was like a super killer combination available. High growth, high margin, high capital efficiency, and durability of that equation for the long period and not short period of time. Therefore, it was like a perfect opportunity, it seemed like. And in that context, even on a regular mathematics, regular investment logic, these businesses look underpriced actually. Forget about fairly priced. They look underpriced. I mean, I remember days when Infosys was just about single digit kind of price earning multiple. Therefore, this was a terrific combination as an opportunity available. The mistake that I would say I managed to avoid, and I remain in a way quite deeply satisfied within, was never to fall for these riffraff and rubbish companies. Many of these rubbish firms had become very popular, and there came a phase of about 1.5 years where these rubbish firms went way higher than the Infosys and Wipros of the world did. And mind you, Infosys that we invested into in Birla Mutual Fund, from the original cost, it went up by more than 3-digit times, more than 100 times. Wipro went up even much higher than that. And we were next to Mr. Azim Premji. We were the second largest shareholder of the firm, of Wipro at that point of time. Mr. Premji, if I'm not mistaken, used to hold some 91% equity of the firm at that point of time. And we were a very substantial percentage equity holder in Wipro at that point of time. And it went up even much higher, while Infosys, if I'm not mistaken, went up some 130, 140 times from the cost at which we originally entered. Wipro went up even higher. Compared to these firms and high quality firms, many of the riffraffs actually went up much higher in that frenzy, when all sense was thrown aside. It not only remained confined to the software, there was a ICE caucus which got developed, which was information technology, communication, and entertainment. Some very peculiar concoction, but many of these other firms suddenly acquired kind of a aura of intellectual capital businesses rather than asset-based, regular humdrum activity. So that was the good thing that I probably at least will give some little credit to myself, will be to avoid completely and scrupulously all the riffraff. And I recollect, without naming names, barring one another mutual fund, uh, uh, apart from Birla Mutual Fund, practically all the funds had fallen prey to the charms of these outrageously bad businesses, bad promoters,
Correct.
and bad balance sheets, and completely zero pretense to any governance. And therefore, it was very tough. On one end, you believe that these other names are dangerous and destructive, but they are the ones which are doing phenomenally well. And on the other end, here you are sitting on the good names, but they are not doing as well. Though in the earlier period, those names did phenomenally well, but then they were struggling relatively compared to that. And how do you hold your faith and belief without with having full confidence that you are not making mistake, because there is always a possibility that I could be making a mistake and I may be wrong about my judgment, and therefore what I'm ignoring is an ugly duckling. Could actually there may be a merit, and what I'm clinging on to, maybe I'm sitting on some problem. So that was one good thing I probably did, but equally, there was a significant mistake I made without any question. Because you didn't want to get into these others, and that was like a no, and these others had performed well, Infosys and Wipro and a few others, uh, and had given a tremendous size and scale and returns, and therefore customer loyalty. Like you mentioned, some of the funds went through NAVs, went up a multiple times in less than a year. I mean, therefore, probably I overstayed in many of the names. Secondly, I allowed disproportionately large weight of some of the names to continue to prevail, saying that those others are not an option. These are the ones which we have got. We better remain with them because other and they continue to look attractive. Therefore, I think I took my eyes off the ball of valuation. They were sound businesses, but whether they were sound values, clearly no. And therefore, when the cookie crumbled, while the bad ones evaporated, and most of them have gone out of existence. They don't even exist as businesses any longer, and several of them. And the good ones also suffered a grievous kind of a blow. And I think that was a mistake. I overstayed in that. I should have displayed courage to have sold them off, saying that if I can't find others or I can't get into others, and these are good, but these are parties long after the deadline is over, I should have displayed courage to have sold off. And I laid disproportionate weight of some of those names to linger on in the portfolios. And therefore, I had fallen prey to, in some sense, intellectual lethargy. Or I would say, I won't call it intellectual arrogance, but certainly intellectual lethargy and uh, unnecessary comfort with the status quo rather than disturb the apple cart. The apple cart needed to be disturbed and to be moved away from, but I discovered that only little later. So tremendous learning from that phase.
That is so beautiful. Thank you for sharing that. I think for most of us who have seen the other side of the fence, and without looking at the investment piece, reading into your mind how things went is going to be a great learning for people who are going to be listening into you. That is very nice of you to share. I think really, really nice. Wonderful. You took us through the whole 99 2000 phase. In fact, up to 2001, I think the I stocks had gone up and started coming down, started correcting. But the most significant most significant point of 2001 to 2003 in my mind was the UTI. I don't want to use the word collapse, but I can't think of any other word. This was probably, this was, what is the word I'm trying to look for? Such a venerable institution. And you were talking about it coming into the spotlight and scrutinized under the spotlight, and not some unsavory details were coming through. There was a committee which was appointed. I'm not getting into that. But I think from a mutual fund point of view, from an asset management company point of view, I've been talking to people and they said that this was probably one of the triggers for the cleanup of the mutual fund industry. I think after this, a series of regulations came in for that. So, what was that you felt was the most relevant regulation which came in, or a set of regulations which came in, and how did you manage that situation? And a little bit about the industry, what the industry was also doing at that time.
On the Unit Trust of India, I think that episode, that fiasco was waiting to happen for decades. The name trust, it was too much reliant on the trust rather than the underlying mathematics and science of what a mutual fund NAVs are all about.
Correct.
Therefore, the prices at which new units are to be issued had complete divorce from the underlying real net asset value of the firm. And given the fact that Unit Trust operated, UTI operated like a black box, because the portfolio was not known, there were not verifiable, transparent calculations of the valuation to justify what the NAV is. And mind you, funds like ours all were had developed the NAV mechanism, yes, and NAVs were declared and which were available, and these were done by third party.
And this was, I think, once a week. It was an internal fund, right?
It was not daily for length of time. But it certainly was at a defined interval. Correct. And it was done by the third party. Correct. So that we didn't have any hand in computing that. So that isolation of the executive arm and the accountability of what is stated is correct or not was segregated. In UTI's case, I think NAV at which new issuances were made or units were redeemed had no connection with the underlying value. Secondly, even the computation was not professionalized, and therefore not only it was divorced from reality, but it was self-serving one, because it sought to kind of keep the fiction alive, what was going on for decades. And therefore, given the fact that it was the first mutual fund, so to say, and in the public sector, therefore it had wrong appearance of some kind of safety of the government support behind it. It wasn't there. There was nothing in the charter of UTI was there. But by practice and by belief, it acquired that safety network around it as if what is being done is right and whatever, nothing can go wrong with UTI. I think all of that created a very, very bad situation to come by for a long period of time. And we just allowed that murky thing get prolonged without any verification. I think the trustee board responsibility also clearly comes into question whether any effort was done or not. What kind of auditing was done of all of this itself raises question. And it also clearly raised the question that while NAVs were transparently being disclosed for others,
Why not?
why UTI had some kind of immunity to that. But all such major and rude kind of shocks is an opportunity finally to clean up.
Absolutely.
And to make things better. And I'm glad. I think it was handled after the fiasco blew over, rather blow out. After it did blow out, we did many right things to solve the problem, to cause a minimal damage to the people. Some damage was inevitable.
Yeah.
But cause a minimal damage, allowed a period of handholding through which the process was NAV transparently then got moved to the realistic framework of computation. And most importantly, it broke the myth of invincibility, because no entity, no financial entity can ever, however well it is run, however strong in value system the entity may be, no entity in a business of financial world can claim complete 100% immunity from anything, which that demigod status that UTI had acquired, it had to be broken. It was for the good of everybody. And I think finally it allowed for the whole thing to be opened up much more, which subsequently led to, I think, insurance being opened up in a similar light.
Yes.
And many other industries which till then were only in the public sector eventually got into the private, which is how it should have been. And in a way, I think UTI issue propelled us in that direction.
I think that's a very fantastic perspective, because a lot of people, when they talk about regulation today, okay, they look at regulation and say, oh, it's very onerous. Oh, we have to do that. Now, some parts of it might be right. But if you look at the backstory from which it is coming, you realize that some of these were organic. If UTI had happened, that is the reason why you had more disclosure, more transparency, NAVs online, and portfolio disclosure started having thick and furious. You mentioned a very important thing about trustee boards. I think trustees became more accountable, and it has since been now structurized. There's a lot of onus on, and it has become onerous to become a trustee, but all for the right reasons. I heard you sometime before when you said they're custodians of money. Okay, and the trustee board is the custodian of the mutual fund money. So
it allowed mutual fund infrastructure truly come of age.
Yeah.
All the support entities which support mutual fund, where mutual fund really focuses then on investing and customer connect, but many other very important bedrock which makes mutual fund happen, computation, technology support, and many other things. A lot of high quality intermediaries and infrastructure support services have emerged.
Absolutely.
So that has allowed it to take off and acquire a size and scale of its own.
Absolutely. In fact, one of the things I realized what also happened was that a lot of processization started happening in the investment management fraternity. I think risk management became the center of the
Of course.
You mentioned some time back about the speed at which the stocks grew. Okay, and there were tailwinds. But I think risk management came in as very effective brakes. And that helped the industry grow even faster. When you have strong brakes, you can speed up even faster. So I think these were some of the very positives which came in.
And I'll make one more point on regulatory remit and regulatory evolution. lot of time I found that we've been relatively less regarding of Indian regulatory landscape evolution compared to the international one. Mainly Anglo-Saxon world of America and UK. Rest of the Europe, regulatory remit, in my opinion, is very poor. Even today, Europe has a lot of gaps in the regulatory remit. But for a length of time, I've heard and generally got a feeling transmitted from others, putting America or UK regulatory remit on the pedestal and kind of looking down upon ourselves. All regulation in any activity is a evolutionary activity.
Correct.
Nothing can be conceived in completeness in advance so that no accident can not occur, or every accident or every damage is prevented. That can only exist on imagination.
Correct.
In any field, in any area, whether medical, whether financial, whether defense, or any other field that you take, regulatory remit is a continuously evolutionary activity. In the process, surely there have been many milestones when we needed to learn, and we have learned many things that we have improved upon, and we did. We must not forget that our markets have become dematerialized way back in 97 or 98. And even today, some of the so-called developed markets are not fully in that shape. Our trading is entirely electronic, with a completely transparent trade. Some of the best markets in the world still operate on some of the archaic principles. Not entirely, but there is that still in prevalence. What at times I think is not given enough credit is how well our overall regulatory architecture has evolved over the period of time. Surely we might have made, there have been points of time when our learning, we got a root shock and we have learnt out of it, but we've evolved all through. And in many areas, I would say our regulatory practices are ahead of the Western world. We don't easily give a credit for it to our own regulatory landscape, but I would say our regulatory environment over a period of time has actually improved ahead of time. In most cases, more proactively and less reactively. So it deserves to get a more credit than typically people are willing to give.
No, I completely agree with you. In fact, I think once regulation, like I was mentioning, starts taking shape, the industry starts going faster and faster. And I think if you look at the period of 2003 to 2005, it was almost like the energy was back again. It was India shining. The FIs were making a beeline to coming here. Interestingly, in 93, 94, 95, there were some AMCs which moved out. The Dundies of the mutual fund, the Jardine Flemings of the world, Sun FNCs of the world. In 1995, in 2003, 2005 period, there were some AMCs which were acquired around that point of time. I think Birla acquired Alliance, and HDFC acquired Zurich a little bit before that.
Birla acquired Apple.
Birla acquired Apple in 99, 2000. Okay. And then acquired Alliance in 2005, I think. Principal taking over Sun FNC. It was happening around the same time. So it was a very energizing period at that point of time. So the point I'm trying to make it is, if you connect regulation in the 90s and maybe a culture towards research and process in the 2000s. And then by the time 2005 happened, you had technology and transparency. This was leading to a lot of energy coming back. SIPs suddenly became the buzzword. Where people started looking at that. You had a large fraternity of distributors now starting to sell. NGOs of the world had really started picking up speed. Okay, what do you remember the most about that environment? Because that was probably one of the periods which laid the foundation, another foundation for the organic. What do you remember about that?
In 80s and 90s, forget about broker defaults. Stock exchange defaults were common.
Correct.
I mean, time to time, stock exchanges were known to default
Yes.
and not honor the commitment on which you have trusted.
Yes.
Broker defaults were dime a dozen. I mean, therefore, it was like a Wild West activity where you are taking a chance on something. Even your transactions, you do not know at what time it is done, at what price, and what is the brokerage charge on that. I mean, entire system was rigged, like in real estate, where practically system was rigged for decades till we came back to senses in last few years, and where culture, ethics, norms of the real estate industry have improved, and therefore that is important reason why real estate industry is now doing well. While it was in a slumber after the global financial crisis, almost for a decade, where it went through its catharsis.
Correct.
Therefore, fundamentally, we have to appreciate that risk assets require a lot of careful nurturing of the entire ecosystem of various participants, and nobody should have any belief about one's own invincibility. In every entity, including infrastructure provider, intermediaries, executioners, regulatory remit, investment vehicles and entities, every single entity is accountable.
Correct.
Is for that ultimate trust upholding of the system, because that guy who is putting that 1,000, 2,000, 5,000, if he had ability to do that himself, he would have done it. He can't, and he wants a low-cost efficient solution. That's why he's coming to the system which he can depend upon. And therefore, while in fixed income, in any case, also is a risk investing, and therefore it can implode if not taken care of. But that risk is much higher in equity investing, and therefore whole ecosystem has to come alive and recognizant of this in order to create self-sustaining, self-supporting, self-confidence building mechanism. And each entity has a role.
Absolutely.
Those who are governed as well as those who govern.
Correct.
And those who provide services and support to those who make decisions. I think the whole ecosystem has to constantly be mindful of that, that ultimately you have only that much right in the system and no more. Like in investing, the day you believe you know everything, you know the death of your investing. Because there is only so much you know in investing, and beyond that is a gray area, and that you may probably learn little or may not learn some of it at all.
Right.
Similarly, in this, every entity has only that much remit and that much strength and that much power. Beyond that, there is no invincibility. And I think
Beautiful.
that is the culture which it is subsuming itself for it to build into a kind of a crescendo, which we are seeing now, where 30,000-40,000 crore of monthly flows are routine. Whoever thought that foreigners can become irrelevant virtually in the inability to influence outcome? I suppose it must be hurting their ego probably. But if you look at the kind of selling in last 3, 4, 5 years that foreigners have done, if it were to occur 10 or 15 years back, market would have lost 50-60% by that. It is sheer power of the system, evolution it is undergoing, maturity of the investment, retail participant, their own deeper commitment to the long term, their own wealth creation and belief that this is the right way to do, in their ability to not get influenced by difficult events in the environment which are bound to come time to time, and yet they're reposing faith that eventually it will all be for the good. I think we have come a long way, and everybody has played a part to make this happen. But I would say it deserves a huge amount of credit to India, Indian system, Indian participants, overall character and caliber of the participants who manage this entire show, both in terms of investments as well as other systems and methods to channelize these savings efficiently through digital and other routes into the system. I think many times we don't give enough credit to how well we do some of the things. We must not forget that in 2008 only, so-called Mecca of capitalism, America, imploded in their financial. And roots of that crisis were not failures of the processes or methods. It was greed, avarice, lack of character, and winking aside on wild kind of abuses that were taking, of which it is obvious that eventually something terrible has to come out. When you know that Lehman Brothers on their balance sheet were carried $58 of borrowing against $1 of net worth, it doesn't require you to be genius to figure out that an accident can very easily occur and it can go down. And yet, whether that system is learned adequately from that fiasco, first of all, it allowed such a fiasco to occur, and then whether it is learned enough, I'm not sure. And to that extent, like they say, "Ghar ki murgi dal barabar," I am not in that camp. I think we as a system deserve a fair bit of pat at our back.
No, I couldn't agree with you, Bharat. There are so many moving parts in running a mutual fund. I've headed a mutual fund. I've run a mutual fund, and I can tell you that there are so many moving parts. Even more so, in the good old days. Folks, we have time for a couple of quick questions, if you don't mind.
Question for you. You mentioned about how Indian markets were affected after the dot-com revolution. So could you tell me about what were your keen observations about how the industry was affected after this new wave of artificial intelligence?
While you keep seeing a lot of opinions floating on both the sides, much more in favor of artificial, some are very derogatory of artificial intelligence. But I do definitely believe artificial intelligence is one of the most dramatic upsurges and change agents which has come by. Ultimately, in investing, for example, one still has an advantage because you are basically weighting or putting your rationality against the rationality of a market at a point of time, and therefore you tend to benefit. That market may lose a mind at a point of time and either outrageously raise the price or outrageously depress the price, like in immediate aftermath of COVID, where in a matter of 5 weeks, markets lost 45%. These things will, time to time, in a cyclic, rhythmical fashion, will occur in the markets. Investing game is harder for AI alone to win. But fundamentally, I have a deep belief in eventual good of the humanity. Finally, while there are valid viewpoints that AI can be destructive and can damage very badly, but I am hoping, and I hope I am not gullible optimist only, but I am hoping that it will eventually be for the larger good rather than some terrible Machiavellian kind of Frankenstein scenarios. Those are drawn up for AI.
Good evening, sir. My name is Geet Inamati. I would like to ask you three skills or three traits uh, that are much more needed, especially a fund manager must possess in the wake of challenges that they face,
Some I already talked about.
especially during the downside of the market.
Downside or upside. In fact, in upside of the market, you are likely to make probably more mistakes than in the downside. Therefore, contrary to popular perception, the chances of bigger and more calamitous mistakes is higher in the rising and ebullient markets, because you start feeling like a genius and you feel nothing can go wrong, and that's where you can fundamentally make very big mistakes. Plus, investing requires you to dwell into future. While humanity is taught to fundamentally spend time with the past and present, you have to train yourself to walk out of that dichotomy. That you, as a Homo sapiens, you genetically for 4.3 million years now that Homo sapiens are around, are hardwired to learn in certain way. But if you want to succeed in investing, you have to go against that and to be able to do that. So you have to fight with yourself.
I think I will not exaggerate if I say that this was a masterclass. Apart from the mutual fund story, apart from the Bharat Shah story which we heard, I think we gained a lot of insights. What it takes a mind which is fighting against the noise in the market, which is answerable to so many stakeholders. How do you build an institution? How do you build a business? And how one such institution amongst so many has built an entire industry. This is what we want to bring to you from the MF Chronicle desk. One of the things I realized is that it takes a lot of guts to stick to your conviction when you're peering into the future. Not everybody can look into a crystal ball and say that this is what I'm going to do. Sometimes your bets can go right, sometimes your bets can go wrong. Two things: one is stick to your convictions, two is be humble in case you're going wrong. And we learned a lot about that in dollops in today's masterclass. In essence, we move from frenzy to fundamentals and from information to insight in this whole decade, from 93, decade plus, from 93 to 2005. Thank you so much, sir. Thank you for being on the show. We are really, truly honored. And on behalf of my entire crew and Vikaas Institute of Management and Research, really, thank you so much.